Wow, this is absolutely crazy. Welcome to today's explainer, everyone. If you've been looking at your stock accounts lately, you know the market is completely tearing up the data storage sector right now. And today, we are cutting through all that market noise to objectively break down the hard data behind Western Digital's massive, frankly unbelievable market run. We're talking about a 90-day return of nearly 97%. That is not normal for a legacy tech stock. So to figure out what is actually going on, I have our chief investment analyst here with me to dig into the numbers.
Thank you for having me. To properly set the stage for our viewers, we really must look at the immediate catalysts driving this. As you mentioned, Western Digital's share price recently surged almost 97% in just a 90-day window. If you look at the news, the headlines are exclusively focused on one massive theme, which is artificial intelligence infrastructure. But as analysts, we do not just read the headlines. Today, we are going to look strictly at the financial statements, the structural supply constraints, and the macroeconomic data driving this exact shift. Based on the data, there are three real causes here: an unprecedented AI infrastructure build-out, structural supply constraints in the legacy memory market, and a highly strategic corporate restructuring.
Okay, let's dive right into this, because when a massive legacy hardware stock nearly doubles in 3 months, my alarm bells start ringing loud and clear. Let's see what actually triggered the latest frenzy. So, take a look at this. We are starting with this staggering number right here on the screen. A 16.10% single-day stock jump. I mean, come on. Why such a violent, aggressive move in a single trading session? What happened?
The data points directly to an institutional catalyst. Morgan Stanley recently lifted its price target on Western Digital from $488 all the way up to $650, while actively maintaining an overweight rating. If you look at the analyst note from that specific day, it explicitly cited strong nearline enterprise storage demand, significantly faster pricing power for the company, and vastly improved operating leverage. Because of this major institutional upgrade, retail and institutional buyers aggressively piled into storage names linked to AI infrastructure. That volume directly pushed the stock up to close at $653.53 that very day.
So what you just said basically means the big money on Wall Street suddenly woke up, realized AI needs a massive physical place to live, and they are betting heavily that Western Digital owns the best real estate in town. Precisely. To understand their business model in this current boom, we have to look at how Western Digital stated it themselves at Computex 2026. AI doesn't just run on compute, it runs on data. The underlying market data shows us that every single AI workload, stretching from the initial training phases to inference and autonomous agentic AI, creates persistent data, and that data compounds over time. The entire tech industry has been hyper-focused on compute chips, but logically, compute simply digests the demand. It is the data that continually compounds. Wait a minute, doctor, stop right there. What does that actually have to do with our stock accounts? That's way too complicated and abstract. Could you give us a simple analogy? Explain this so even an elementary schooler could understand what Western Digital's actual business model is in the middle of this AI boom. Certainly. Let me break this down for you. Think of artificial intelligence as a massive, high-speed restaurant kitchen. The compute chips, the expensive GPUs everyone is always talking about, are essentially the ultra-fast chefs cooking the meals. But Western Digital is the giant temperature-controlled warehouse in the back where all the raw ingredients and the recipes are permanently stored. You can hire the absolute fastest chefs in the world, but if your warehouse isn't big enough to hold the ingredients, the entire kitchen stops operating. Western Digital manufactures those massive warehouses, and right now the kitchens are ordering more ingredients than ever before in history. Oh wow, I absolutely love that kitchen analogy. That makes perfect sense. So here is our roadmap for today's explainer. First, we are going to look at the AI storage boom. Second, we will dig deep inside the Q3 financials. Third, we'll examine Western Digital's economic moat. Fourth, we'll look at the SanDisk spinoff factor. And finally, we will be forecasting the future scenarios. All right, moving on to Section 1, the AI storage boom, beyond the hype. Let's get into it. If we look at the corporate positioning as of early 2026, the newly rebranded WD is intentionally positioning itself as the foundational storage layer for the entire AI-driven data economy. This is backed by industry data telling us that 87% of AI leaders are currently shifting their operational priorities. They're moving away from just seeking peak compute performance and shifting toward building durable, scalable data systems.
Western Digital is capitalizing on this exact shift by aggressively marketing their high-capacity hard disk drives. They are specifically targeting the explosive, undeniable increase in unstructured data that is being generated by all these cloud-based services.
Got it. So what you were saying is they completely rebranded their whole image to basically scream, hey, Wall Street, we are the foundational AI data warehouse company. And looking at that stock chart, it is definitely catching everyone's attention for sure.
Okay, Section 2, inside the Q3 financials, cracking open the actual earnings. This is where the rubber meets the road.
The financial statements from their recent report reveal the sheer velocity of their corporate turnaround. Looking strictly at the numbers for Q3 fiscal 2026, their total revenue came in at $3.34 billion. Operationally, they successfully shipped 4.1 million units of their latest generation EPMR hard drives. But more importantly, from a balance sheet perspective, they systematically reduced their debt and officially achieved a net cash position. These numbers prove fundamentally that the AI storage narrative is not just hype. It is already translating into real capital and real earnings. Wait. Hold on a second. They are making good money, taking in $3.3 billion, which sounds great. But I see on the data here that their non-GAAP earnings per share was $2.72. Is that actually a good number compared to where they were? Why is the market going completely wild over $2 a share? It is actually exceptional when you measure it against historical performance data. Their GAAP-diluted net income per common share was $8.20, which mathematically represents a massive 289% year-over-year increase. The non-GAAP diluted EPS of $2.72 that you mentioned is a 97% year-over-year jump. This specific metric shows aggressive operational leverage. In financial terms, it means they're controlling their internal costs brilliantly while their top-line revenues surge.
Expanding on that profitability, if you look at the margins on this chart, we can observe a massive 1,040 basis point expansion in non-GAAP gross margin year over year. It climbed all the way from 40.1% up to 50.5%. At the exact same time, their non-GAAP operating margin expanded by 1,260 basis points to reach 38.6%. So the data proves they are not just selling more drives, they're actively selling them at a significantly higher profit margin due to incredibly tight supply and persistently high demand across the enterprise sector. OMG! 1,040 basis points. For our viewers who don't speak Wall Street, that means their gross profit margin jumped over 10 full percentage points. That is absolutely massive for a hardware company. So they're basically charging a massive premium because everyone is desperate for their product, and their profit margins are absolutely exploding right now as a result.
Correct. The full financial flow perfectly illustrates this. The data shows revenue is up 45% year over year, but directly because of that margin expansion we just discussed, their operating income is up 116%. Most importantly for valuation, cash flow from operations reached $1.12 billion. That led directly to a 124% increase in free cash flow, hitting $978 million. Wait, stop right there. What does this actually mean for their bottom line and for our stock accounts? Are you telling me they are taking a 45% bump in sales, but somehow converting that into a 124% increase in free cash flow? How does that math even work? Yes, the math is entirely driven by high operational efficiency. When a company's fixed costs remain stable, but their product pricing and sales volume increase rapidly, that resulting extra revenue falls straight to the bottom line as free cash flow. And what did they do with that cash? The records show they used it to execute $752 million in share repurchases. By doing this, they are returning capital directly to shareholders and inherently boosting the mathematical value of all the remaining outstanding shares.
Okay, now for the sharp, contrarian question of the day. I am hearing all these amazing numbers. They are literally rolling in cash, buying back shares. So why is the broader market throwing mixed signals? Why do some analysts out there claim the stock is actually 8.6% overvalued right now at its current price? If they are a money-printing machine, shouldn't the stock just keep going up forever?
To answer that logically, we have to transition to the industry environment and look closely at their actual hardware and the broader market cycle. Stock valuation is always based on forecasting future cash flows, and historically, memory and storage markets are notoriously cyclical. If the current supply and demand imbalance normalizes, meaning supply catches up, those thick profit margins we just praised could contract very rapidly.
Which brings us perfectly to Section 3, Western Digital's economic moat, checking the actual hardware powering AI. If you look at the technological landscape and the data provided, there is a very clear division in storage.
Solid-state drives, or SSDs, are incredibly fast and completely essential for localized compute performance. They handle the rapid feeding of data to GPUs. However, traditional hard disk drives, HDDs, remain the undeniable, cost-effective backbone for creating massive data lakes. According to comprehensive IDC research data, enterprise SSDs currently command a 7.4 to 9.9 times price premium over capacity enterprise HDDs. Therefore, hyperscalers desperately need these traditional HDDs to store the massive exabytes of raw AI data economically.
Really? Almost 10 times more expensive for the fast stuff? Wow. So even though everyone and their mother thinks HDDs are just old, outdated spinning disk technology, they are actually the only affordable way on the planet to store the literal millions of terabytes of data that AI needs to learn from.
Exactly. And that harsh economic reality is exactly what creates Western Digital's moat. The numbers prove they are deeply integrated with the top 5 hyperscalers in the world, all of whom currently have firm purchase orders and long-term agreements covering the next 12 to 18 months. Furthermore, Morgan Stanley's data projects that annual HDD demand is going to grow 40 to 50%, while the global supply is only growing at 30 to 35%. Additionally, rising NAND flash prices push even more enterprise users to adopt HDDs for their bulk storage needs.
So what you just said basically means there is a severe structural supply shortage. Because HDD demand is significantly outpacing the supply growth, Western Digital holds an irreplaceable weapon right now: incredible pricing power. They basically have the absolute biggest tech companies in the world locked into contracts, literally begging them for warehouse space.
All right, Section 4, the SanDisk spin-off factor, a strategic uncoupling. Let's look at how they changed the company. Yes, in early 2026, Western Digital officially spun off its SanDisk flash memory business. By doing this, they reverted to being a pure-play hard disk drive company. The historical financial data clearly shows that trying to balance both flash memory and traditional HDD manufacturing subjected the overall company to intensely conflicting cyclical market pressures.
Hold on. Why split up a good marriage? If they own both the fast, expensive SSDs from SanDisk and the cheap, massive HDDs from Western Digital, wasn't that the perfect, diversified combo meal for investors?
No, because it severely clouded their valuation on Wall Street. As I mentioned, the memory industry is fiercely cyclical. By legally uncoupling from SanDisk, Western Digital is no longer balancing two completely different tech and capital cycles. It allows their management to focus purely on high-capacity enterprise HDD demand. This move makes their financial metrics much easier for Wall Street analysts to value as a dedicated, pure AI infrastructure play. Historically, pure-play companies almost always command higher valuation multiples than conglomerates that have conflicting, cyclical business segments dragging them down. Following that initial spin-off, Western Digital recently announced plans to exchange roughly half of its retained SanDisk shares for its own stock. This effectively cuts its remaining stake in SanDisk by about 50%. This strategic stake reduction acts as a vital cleanup of cross-holdings. It legally gives both companies far greater capital autonomy. It allows Western Digital to aggressively fund its high-capacity HDD roadmap without ever worrying about subsidizing SanDisk during consumer flash memory market downturns. Oh, I see. So they are officially divorcing their finances for good. This gives both companies the total freedom to spend their own money exactly how they want, and it makes it much easier for retail investors like us to directly evaluate Western Digital's AI storage upside without carrying all that flash memory baggage. Finally, Section 5, forecasting the future scenarios. We are looking at the bull, base, and bear cases. What is next for the stock? Based strictly on the data, we look at 3 specific survival scenarios, each with very specific preconditions or triggers. First, the bull case. If perfect strategy execution continues internally and the structural HDD supply shortage persists exactly as Morgan Stanley predicts, the stock trends strongly toward that $650 target. The necessary trigger here requires the hyperscalers to continually expand their AI data lakes without any major technological disruption or significant capex reductions. Second, the base case. Statistically, this is the most likely future based on current data. Demand holds steady, and the market successfully maintains its current valuation multiples, smoothly absorbing the company's growth at a moderate, sustainable pace. Third, the bear case. Valuation models from some quantitative analysts peg a fair value of $518.26, utilizing an 8.44% discount rate. The trigger here would be a classic cyclical market correction. This happens if supply finally catches up to demand, which would crash HDD prices, or if the hyperscalers' long-term agreements are unexpectedly canceled due to a broader global economic downturn. Okay, so just to summarize for the viewers, the bull case relies entirely on persistent HDD shortages and Wall Street continuing to throw money at the AI narrative, while the bear case warns of the classic, terrifying cyclical memory drop, where too much supply eventually ruins the whole party. Exactly. And to understand which scenario the market is leaning toward, looking at their price-to-earnings ratio puts things into proper perspective. Their PE ratio is currently sitting at 30.6 times. If we compare that against a peer average of 57.1 times, we can see a massive gap. While WDC is trading slightly richer than the broader global tech industry average of 23.7 times, it is well below its direct AI peers. The numbers prove that the broader market is still heavily discounting risk for Western Digital. Institutional investors are not blindly assuming this supercycle will last forever. They have clearly priced in a margin of safety compared to the broader AI peer group. This entirely reflects caution about that potential cyclicality we just discussed.
Wow. So even with that 97% run-up, they aren't even the most expensive kid on the block. The data shows the market is still slightly terrified that the cyclical monster is hiding under the bed, which is why they are trading at 30.6 times earnings instead of 57 times like their peers.
Well, to sum it all up, with a famous stock market quote that fits the situation perfectly, the stock market is a device for transferring money from the impatient to the patient. If Western Digital can hold on to these incredible profit margins and maintain their massive economic moat, patient investors could see some truly great returns. But if that historical supply cycle turns against them, watch out. As we wrap up today's explainer, I'll leave you with this crucial question to consider as you evaluate Western Digital's future in the AI data economy. Is the AI storage boom fully priced in? Thank you so much for watching today's explainer, everyone. Your subscriptions, likes, and supportive comments are a huge encouragement for our production team. We'll see you next time.